Let me step back and sort of ask what are financial markets for? And I think one role is to allocate capital, and an important corollary to that is that they provide insurance against all kinds of risks, right? So it's really a way to absorb risks and help the real economy take decisions, allocate capital, and get to economic efficiency. So when you look at finance from that angle, you sort of ask, what are possible sources of risk? And there are, of course, many risk factors, right? And being an institution such as the International Monetary Fund, looking at the evolving policy landscape is a natural question. So asking to what extent financial markets absorb surprises in policies is very first order. And so what we're doing in this chapter is to focus in on one particular source of risk, which are labeled geopolitical risks. And so let me give you an example of what we have in mind here. These could be, for example, conflicts, military conflicts or wars. It could be terrorist attacks, or it could be, first-order policy moves that have implications for financial markets. And, many of the motivations for those policy developments are outside of the IMF's policy mandate and certainly outside of the financial sector policy mandates. But it's important to sort of think about these sources of risk and to then ask, is the financial sector well equipped to provide insurance, or is the financial sector sometimes at risk to actually not being able to provide the insurance? And that is sort of the fundamental financial stability question, right? So, well-capitalized firms can deal with all kinds of adverse shocks. But of course, sometimes, firms do falter, and that is very natural. But that sometimes can lead to an amplification of shocks. And so the financial stability angle is really about asking, do we have the right policy levers here that assures that the financial system can do its job effectively? And so the chapter is really about focusing in on this one particular source of risk and then asking, what is the implication for asset pricing and ultimately for risk management and regulation of the financial sector, so as to be sure that the financial sector is equipped to provide its very important functions in the face of various shocks.
You spend a lot of time with investors around the world. How do they think about and price geopolitical risk? I mean, there's all these fancy consulting firms that have ratings. How do they go about doing it? How good are they at doing it? And can they use the markets to hedge against financial risk, or does hedging just mean if Russia's going to go to war in Ukraine, sell your Ukraine stocks?
Well, I think the way that markets look at geopolitical risk has shifted over time. For many years, there was a feeling that you can just kind of see through the noise. It's more noise than determining the trend. But I think that COVID and Russia-Ukraine actually pointed to shocks that were seen as much more permanent rather than transitory. And so where the market is today is really debating that this regime change that we're going through right now, is this transitory? It's going to be a one-off shock, or is it something that's more permanent in nature? So in that way, I think the questions have really shifted over the last couple of years, because there's a feeling that this is about regime change. It's about a new world order. And so you've got to then break down, is this permanent or transitory as the first step? And then you have to really look at the sources of the shock. And we divide this into sort of 4 different categories. For this particular episode at JP Morgan, we're looking at the trade channels. We're looking at the Doge fiscal angle. We're looking at the immigration channels and also the deregulation and the interaction between all of this and what this will mean for financial channels. So is there a way to hedge this risk? Well, what we've seen in the last few days is a risk off. The compression of swap spreads, questions about whether there should be rotations away from growth and into more value, into more safe haven currencies like Swiss franc. So I think we've seen this evolution, which I think is different than it had been when I first started my career, in the late 80s, early 1990s, because there's a sense that, this process of deglobalization may be a misnomer, but a rebalancing to a new world order is leading to some shifts that are more permanent in nature, rather than some of the transitory noise, which markets have usually viewed geopolitical risk as.
I see. So the chapter, by taking the long sweep of history, kind of averages across a lot of things, and you're suggesting this time may, in fact, be different.
Well, I think COVID raised that question. Russia, Ukraine raised that question, that the supply chains, we saw material shifts in trading patterns. We saw material shifts in the flow of funds, and I think the questions have evolved over time. Yeah.
So Felix, how well do you think investors price geopolitical risk? How good are they at putting the right odds on it?
Yeah, so what we find in the chapter, I think it chimes well with what Joyce was just saying. We do see that investors tend to price these risks which are very hard and complex to price, of course, right? I mean, as we just said, every event is different. It depends a lot on the country characteristics where the events occur. There are differences in terms of the duration of the events and their scale and so on. So these are very complex risks to price. But what we see in the chapter is that investors seem to be able to price them to some extent, especially when we look at the period starting around 2012, 2013. That's sort of when we see a significant risk premium that investors demand for holding stocks in our particular analysis that are exposed to geopolitical risks. So stocks that tend to decline when geopolitical risk shock occurs. We also see in option markets that investors ahead of or around the time of geopolitical risk events demand a premium for or are willing to pay a premium for insuring against downside risk and downside tail risk. So these are, I think, both pieces of evidence that investors do, at least to some extent, price these risks. Of course, that doesn't mean that when an event unfolds that markets wouldn't move, right? When the uncertainty is resolved and events occur, we still see large asset price reactions, and we also have that in the chapter. But we do see that investors do tend to price these risks ex ante.
Yeah, so emerging markets are a big focus at the IMF, and I think the surprising thing of the surprising observation of the past 5 years is that emerging markets have been actually very resilient, and I think that is a bit of a regime change relative to the 1990s and early 2000s, where you saw a lot of vulnerability. And at the IMF, we do like to take some credit. We do hope that our policy advice, we don't get it, but I'm always happy to imagine that we get it. We spend a lot of time engaging with all countries around the world, including emerging markets, to think about policy frameworks that help countries buffer against shocks, and that includes financial regulation, which is the focus of this chapter, but of course also monetary policy frameworks, reserves against capital flow shocks, and of course fiscal frameworks. And we do see a tremendous pathway that has been taken over the last 2 decades. It is true that some markets are thinner, though the major emerging markets have pretty deep capital markets at this point, right? So when you think about most of the G20 emerging markets, their bond markets, their derivative markets, their stock markets are pretty deep, right? So, it's not it's not quite the size and depth of, say, the US or Europe, but it is substantially different. And so when we think about the shocks in the past 5 years, emerging markets have actually fared pretty well. Yeah. Of course, when you're directly hit by a conflict or by a domestic major political event, of course you will still be subject to that.
I think one key point is, as I mentioned earlier, that these risks are very specific, country specific in terms of the vulnerabilities of the country. So emerging markets, for example, we do find that it is important to have, for example, enough fiscal space when a shock occurs, not just a shock in your country, but also maybe in a major trading partner of a country.
So this sounds more like you think that bank regulators should, or supervisors should look at the book of businesses of a big bank and say, I don't know, you have a lot, you're pretty heavy in this particular region of the world, and we think you ought to be more set aside.
So what we're saying is to have the capacity to analyze these risks, for example, in stress tests, looking at different scenarios that take these risks into account. I don't know if Tobias wants to come in.
Yeah, exactly. So, scenario analysis has become, foundational for risk management and for regulatory approaches. And, the question is always, what are the kinds of scenarios that you should imagine? And, depending on what country you're in, you would certainly imagine that different countries have different scenarios, and this geopolitical risk dimension is one that is particularly important for some countries, but perhaps less important for others.
We start also with the scenarios, but what is the end game in all of this? So I think the question that we're asking is, what is it that the tariffs can and can't accomplish?
Right.
In this episode, and we get questions like, if there is a recession, what kind of recession is it? The sell-off that you're seeing right now in the financial markets, is it orderly or disorderly? I mean, it's been big, but it hasn't been disorderly.
Right.
So I am not really seeing the intermediation risk right now. But we are asked to go through the scenarios of what level of interaction could cause more stress in the system. So which countries can and can't retaliate? If they can retaliate, what form might that take? And how could that hit different financial channels? And so there's a range of scenarios, and banks, we put out probabilities. I mean, we do have a 60% probability of recession that we'd had even before the announcements just came out, that we still keep it as maybe a closer call, but we still have a recession call just given the events that have played out. And then there is sort of what is bearable. Is a 10% tariff bearable, but if it goes much, much higher, it's not bearable. So it's trying to define the stress thresholds, the different ways in which the channels could interact and lead to capital outflows and greater financial market stress.